Welcome to the James McDuffie Podcast, Perspectives. Today is a YouTube video. Well, it'll be on podcasts, but you probably would prefer seeing what I'm going to show on the video version of it instead of just the audio version. So today I'm going to talk about basic investing and taxes 101. Some people might call these very complicated topics. I would agree, they are pretty complicated topics, but once you learn the basics, it's not too bad. Let's get into it. Okay, we're going to start with basic investing, and then we're going to move into understanding taxes a little bit better. And I feel that taxes are probably some of the slightly harder to understand pieces of what it means to save. So we'll get into that. But first, let's understand a little bit of basic investing. So first off, you need to understand that there is something that's called a financial statement. And so anybody can make their own financial statement. You can put one together in Excel or Microsoft Word or, free Google Docs. But the basic idea behind a financial statement is understanding where your money is going. Okay? There's this great book called Rich Dad, Poor Dad by a guy named Robert Kiyosaki. And he really does a great job of explaining what a financial statement looks like, whether you're poor, middle income, or a wealthy person. And I'm gonna put a graphic right here that kind of allows you to see the differences as we discuss it. So what is there's a couple pieces that you have to understand when you're thinking about a financial statement. And a financial statement has your income as well as your expenses. And that's the easiest way to think about this is as you work, you gain income. As I buy things, those are my expenses. Now, other things can be expenses. Your rent can be expenses. Your food, water, gas in your car, all those are considered expenses. And there's a lot of different types of income. There's active and passive income, and we'll get into that in a little bit. But the idea is incomes are things that give you money. And a active income is something that you have to actually work for regularly. A passive income is something that just sits there and works for you. Think about real estate or stocks. And again, we'll get into that a little bit later. So the next piece of a financial statement is understanding your assets and your liabilities. Okay, and so an asset is things that you own that make you money or provide value to your portfolio. Liabilities are things that add risk. They mean that if you lose it, it could substantially financially hurt you, and the value over time doesn't get better, the value over time gets worse. Well, an example of a liability is a car. You buy a car new, maybe you spend $20,000, $30,000 on it. Well, over time, it doesn't retain its value. After you're done using it, actually, after you drive off of the lot, it immediately decreases in value. If you were to sell it 5 years later, it's not even worth half the value. That's a liability. And if it breaks down, you can't sell it for value. It's just gone. Assets are things like if I have a rental home that I'm renting out, well, that provides me some level of passive income. Or if I have a bunch of stocks, or if I have bonds, or if I have precious metals, those are things that never really lose their value and they don't really break, right? And so understanding your entire portfolio as to what is your income and what is your expenses and what your liabilities versus your assets are is very, very important to being able to build a financial statement. Now, if we're talking about general wealth brackets, a typical poor person has income coming in, and that income goes directly into their expenses. So they have no extra money in their budget, and they have nothing that's an asset that works for them. And so the financial statement is a very simple diagram. It's money in, money out. Their money in is their salary or their paycheck, and their money out is food, utilities, housing, gasoline, spends all their money on the way out. Now, if you think about a middle class income, people think that they have assets when they buy a house. So they buy a mortgage and they have a house, and this house they're just dumping their money into. So they're putting money into their house, but if that house burns down, they lose all of their money. So I don't really consider a mortgage an asset. I consider a mortgage a liability. If I have another house that I'm renting out, I'll have insurance on that house. If it burns down, I'll recoup all of my value, and I don't lose my own living. It doesn't cost me anything extra temporarily while I'm trying to find a new place to live, right? It's just extra on top of things. So a secondary house I'm renting out or a secondary house I'm holding for real estate value is an asset, but my own house, my own mortgage is considered a liability. And so a wealth or a middle class type of financial statement has money coming in, most of their free money going into their mortgage or their car payments, which are, as we stated, both liabilities, and then the rest of their money going to expenses. And that's it. So they have no money actively going into their assets. They have no money actively going into other sources of income. And so their money comes in, their money goes to pay off their mortgage and their cars, and then it immediately goes out the door, and they're living paycheck to paycheck. These are the typical financial statements of what you see between a poor person and a middle class person. And the middle class person, sure, they have some value in their house, they have some value in their car, but it's not a lot of value. They're not actual assets making money in their portfolio. And that's where it comes to the rich person's or the wealthy person's financial statement. So the wealthy person's financial statement has a whole bunch of assets, and those assets are earning money, and those money come into their income, and they have income. Now, I'm sure they have some expenses, and I'm sure they have some liabilities, but the idea is that most of their money goes into their assets, or most of their money is just coming in from passive income sources. So their money is making money. They're not actually working for that money. It works for itself. And then they have a minor amount of expense and a minor amount of liability. So if their expenses go up a little bit, they don't have problems. If their liabilities go away, let's say their house burned down or they lost their car, it's really not that big of a deal to them because they still have other means of income. And another good example of why a car is a liability, if your car breaks down and you can't make it to work and you can't get your job or salary or your income because of it, that's a liability. It's a huge problem for you if you lose it. And another reason a mortgage is a liability is if you lose your house for whatever reason, you have to deal with that. It's not just something that's, if I had another house and I have to go get it fumigated and I don't have to live in it or people can't live in it for 3 weeks, it doesn't affect me. It's just 3 weeks that it's kind of useless not doing anything. If I have my own house fumigated, well, all of a sudden I have to get a hotel, I have to, pay extra expenses. It's a liability. And hopefully that understands a little bit on why mortgage and cars are considered liabilities. But that's the biggest difference between a poor person's financial statement and a wealthy person's financial statement, is that the wealthy person has assets, and those assets are providing value or income into their portfolio. Okay? Now, most of us, as we get started in life, we don't have assets. I didn't start magically with assets. I went to college, I had a big loan, I got out of college, I bought a house, I bought a car, and so most of my money for a long period of time was just being thrown away into my liabilities, and I actually wasn't building wealth, okay? That gives you the more important question of how do you build wealth, and where should you put your money so that you can build wealth? Some people don't like buying houses. Some people don't buy mortgages, specifically because they prefer not having the house liability. But more importantly is you have choices when you're taking your money onto where you want to put it. So you can put it into investments. You can put it into markets. And markets are interesting because they have ups and downs. Every market has an up and down. I don't care if it's precious metals. I don't care if it's stock market. I don't care if it's real estate. they all have ups and downs for the amount of money that those markets make for you, right? And so playing markets is typically a very unsafe investment option. So if I were to go to the stock market tomorrow and I'm just going to find one stock and put all my money into it, well, that's risky, because the stock market, no matter, don't listen to anybody else. The stock market is risky. Okay, we have financial crashes. The market has ups and downs. Now, there's ways to minimize the risk in that market, but the same goes in real estate. You had the huge real estate bubble back in 2005, 2006, and then it just disappeared the next year. And so every market has ups and downs. And the old saying is very true. Don't put all your eggs in one basket. And so where should you put your money? Well, you should invest it in a strategy, in a portfolio of many, many things. And so while some things are doing really well, other things may not be doing so well, and you can make money over time in the long run. And so markets are interesting. Typically, because of inflation, most markets have an upward trend. And an upward trend is where just over massive amounts of time, whether it's 5 years or 10 years or 20 years, the line goes up, right? And most of that is because of inflation. But it's also because we have a strong economy and that we have a good GDP in this country. And so our markets typically are pretty stable. In other countries, that's not entirely the case. In other countries, markets are wildly swing just as bad as any single stock does. And if you read a lot of financial books, the message is pretty consistent from every major economist in the world. Markets might as well be random number generators, because sometimes they're going to go up and other times they're going to go down. And you can always look back and try to identify what caused the market to go up or down, but you don't know. And so the way I think of markets is markets are distributive intelligence. It's like crowdsourcing or crowdfunding. You have 1,000 people, or in this case, millions of people that are investing in the market, and they can see problems and benefits faster than a single person can. And so the market responds because you have tens of thousands, hundreds of thousands responding to a particular event that you're unaware of, and the market does something that you can't predict. And because you can't predict it, that's the important key. It can be very unsafe to invest all your money into a single horse, a single stock, a single pony, a single house, right? And so the best way to do it is to really have a wide range of investments, a little bit in real estate, a little bit in the stock market, a little bit in bonds, a little bit in precious metals, a little bit here and there, so that the averages, which is what should really matter to you, allow you to make money over time. Now, a good example of how a market average can make you money, and I'll cover this more in a basic stock video, Stock 101, but if you're following the S&P 500, for example, over the last 20 years, it has performed 9 to 10% on average over the last 20 years. And 9% returns is a great return on any investment. That is a lot of money, okay? Especially compounding interest over time. It is just crazy how much money you can make by investing in market averages. But the thing about the S&P 500 is it's S&P 500. You are literally investing in the 500 top companies in the market. That's not what I really call investing in a single stock. So even if you went and you bought all stock just in S&P 500, you're essentially investing in 500 companies. And that is a good investment portfolio to invest in a large amount of companies. Now, stocks shouldn't be your only thing, and that's something that I really want to emphasize. You shouldn't have all of your money in one place. Now let's talk about passive income and active income. Let's get down into the nitty-gritty a little bit more, okay? So active income is, let's say that I buy a property and then I sell a property, and I made a profit as I watched the market change. I had to actively watch it as the market changed to determine based on taxes. By the way, you sell a house, you pay a lot of taxes. Just be warned, it's not all profit, even if the value of the house goes up. So let's say that I invest $200,000. Well, then I have to watch what the market does, and a lot of a lot of times people can't resell those houses immediately. Instead, they have to fix them up or put more work into it. Well, you're actively working. That's like a second job, right? So that's an active investment to buy and sell properties and renovate them and make them better. And then there's playing the stock market. And that's not investing in the S&P 500. That's not having a set of portfolio of stocks of companies that you care about. That's saying, hey, I heard a rumor that this stock's going to do really well, so I'm going to invest my money into it, and then it crashes. You lose money, or you can lose money. Now, if you're really, really good at it and you have a lot of statistics and you understand the business and the marketplace, you can make money that way, but in my opinion, you might as well be gambling, right? But in those cases, you're actively watching the market. I know friends of mine that spend more time watching the market than they do their day job. So that is not a passive thing. It's not just making money. You are working hard to watch those markets to determine when you buy and when you sell. It takes a lot of time. And then last but not least, the most simple example, which is your day job. So you go to work, you've made a social contract with a company or a retailer that you're going to do X and Y and Z, and they're going to pay you X, Y, and Z amount of money for it. You are working for that money. So that's active income. Most rich people have less active income and more passive income. So passive income is stuff you don't have to do. So if I go in and I buy S&P 500 and I know the market average is 9% per year, and I just put a lot of money into that and I leave it for 10 years, I will get 9% per year. It's making money for me. I did nothing. It's just, I put the money in and my portfolio gets bigger, okay? The same thing happens with rental income. So if I go buy a duplex, or I get a loan, obviously you get a loan from a bank, you buy a duplex, you fix it up a little bit, and then you rent it out to people, you're not doing much. You might have to, replace an appliance every now and then, but for the most part, you have other people that are taking care of your property and they pay you a rent check every single week or every single month. That's called passive income. And so you're passively earning money. Now, you can say that you have passive income in real estate with certain real estate investments. So if I buy a plot of land and I just let it sit for 5 to 10 years and I watch the real estate market go up over time, it's essentially the same thing as a stock, right? The same thing can be said for a bond. A bond is typically 1% to 4% back. You buy a bond, they guarantee a certain percentage over time. It's passive income. You know it's going to make that 3 to 4% over the number of years that you set that bond for. That's guaranteed money. You don't have to work for it. It's passively increasing your portfolio, right? And then, interestingly enough, hey, YouTube, ad revenue. So most people in YouTube world, they make videos, they get sponsors, and then they're done. They made a video. Now, sure, they make more videos, but their video makes money for every time somebody watches it. And so that's passively making money for them. So getting a YouTube channel that's sponsored, that makes ad revenue, is considered passive income. I know people that do training videos for things like, or places like Pluralsight. It's the same thing. So everybody that uses your training video because you did a good job on your training video, that's passive income because you get a certain amount of money every single time someone takes your course. So those are just examples of what the difference is between active and passive income. So I get this question a lot. How much money should you invest? As much as you can. I know a lot of crazy people that think you should invest 60% of your income before taxes. So if you made $1,000 a month, you would invest $600 of that, $500 to $600, and then you would pay taxes, and then you would live off the rest. And there's a great blog site I would recommend called Mr. Money Mustache. That's essentially what this guy did. This guy took all of his money and he lived with his parents and lived off of top ramen for a decade. He was a software engineer, and he saved all of his money for 10 years until he had more than $1 million. And then he retired at 32, or I think it was somewhere in the early 30s. You can do that. The question is, how much money do you want to save and what are your goals? If you're like me, I'm not really worried about retiring or doing other things. I enjoy my career. I like my job. It gives me a lot of flexibility. I don't really see myself as needing to retire by the time I'm 40, right? And so my goals, my savings goals, may be over a much longer period of time. So the question you have to ask yourself is, what are your goals and how much do you think you should save? You can do what Mr. Money Mustache did, which is live with your parents for free and save all of your money for 10 years. You can earn a couple $1 million. So it's really up to you. I would suggest finding a livable amount of money that you're comfortable with your lifestyle, and then every penny over that you save. And we'll get into some of those strategies in a little bit, but there's things you can do. So I get this question all the time. When is the best time to invest, and when is it the best time to invest in certain markets? First and foremost, the best time to invest is now, period. You may see a tank in a market every now and then. Typically 10 to 20 years in that range, you'll see a dip in the market, but you can't predict it. And every financial book I've ever read has said that if you miss the best day in the market, you might as well have just skipped the entire year. So if you miss the one day in the entire year that was the best day in the market, you should have just skipped the entire year because you earned nothing. Those last 4 or 5 months this year, just great gains in the stock market. Fantastic. I might have gained somewhere in the region of 7 to 8%. But I had a bunch of friends that thought that the market was going to do the normal thing in November, which is tank and then recover in January, February, March, and it didn't do that. So what happened to them? They missed 8 to 9% returns over the last 4 or 5 months because they pulled all their money into cash. So, you can do that, and sometimes you'll get lucky, or sometimes you'll just miss the biggest increases in the market. My recommendation is invest as much as you can afford, as early as possible, and hold it for as long as possible, because you win in the long run, you don't win in the short run. And that's really important, is I don't invest to retire in 2 years. I don't invest as a get-rich-quick scheme. There are plenty of people out there that make millions of dollars or tens of millions of dollars, hundreds of millions of dollars, and they're very lucky individuals. More power to them for being very lucky individuals. Most people aren't that way. Most people do better with a savings plan and a set amount of money that they invest regularly over a long period of time. It's like that grandmother that put money in the mattress, and by the time she died, she had millions of dollars in the mattress. Now, I don't recommend putting money in the mattress. I recommend investing and then identifying when you have enough money so that you can enjoy life. But the best time to do it is always now, and to plan for the long run, not the short run. Okay, so there's a lot of tools online that you can use, and I briefly want to mention these. There's a lot of standard stock tools that I use, Fidelity, Vanguard. It used to be where a couple of the smaller players in the stock market would charge you for every transaction, and I think it was Robinhood that gave you a certain number of free transactions under a certain dollar amount, but pretty much everybody right now doesn't charge you extra money for transactions. And so it used to be better to save your money in cash until you had enough to make a big transaction. Otherwise, the cost of the transaction cost you 5% of the total value, and it wasn't worth it unless you had a larger chunk to invest. But nowadays, invest regularly, often, and nobody really charges you for small transactions. So you can get in, just make sure your money's in the market whenever you can. There's other things I like as general tools. So you can use Quicken, you can use Mint. My personal favorite is Personal Capital. I love Personal Capital because I can put in all of my accounts across the board of any given type: stocks, bonds, financial or housing markets. I have Zillow tied in for the values of my real estate properties, and I can track it all together really, really nicely in a single graphical display. It's just a nice way of being able to see how all of your portfolios are doing simultaneously. I know a lot of friends that prefer Mint, so whatever works best for you, just pick the tool that you like. But it's nice, it's on your phone, you can check it daily. It's pretty sweet. And I like my Fidelity accounts because my Fidelity accounts kind of do the same thing, but I can watch the market and individual stocks on a much more granular level. But most stock market apps do the same thing. So it doesn't matter whether you're using Fidelity or Vanguard or Robinhood or any of the other guys. They all work pretty much the same. But they're all really nice tools. So just make sure you get in and you play around and you look at it. So I want to say that the most important thing that I've learned in financial investments is these two things, biggest tips, okay? Number one, create a savings plan. Well, what is a savings plan, James? A savings plan is a plan that you make for yourself on how much you're going to save, okay? So if you say, I'm going to save $100 a week, save $100 a week. If you say, I'm going to save 10% of my salary or 10% of my wages, save 10% of your wages. The most likely way for you to become wealthy is for you to A, create a savings plan, and the second biggest tip is follow your plan. Every single major investment or an investment advisor says that the easiest way to get rich is A, have a plan, and B, follow your plan. Okay? So those are the two biggest tips. Create a plan, follow your plan. That's it. It's really actually pretty simple. But there are some strategies for how you can become wealthier quicker. Okay? So the first one is automatically deducting money from your paychecks, and especially every time you get a raise. So the way I like to think about this is if you get a 5-cent raise or a 20-cent raise, or let's say that you're an engineer and you just got a 2 to 5% raise, whatever. If you're living comfortably on the money that you're making, realizing that money means that you're just going to spend it. All of us live within our means. If we have cash in our cash accounts, we typically spend it. The thing I like about getting payroll deductions is it goes into a separate account. And once it's in that separate account, I pretend like it doesn't exist, right? Every penny in my checking account, I will spend every 2 weeks. It all disappears. But I've already taken all of my money for savings out first. So the check I see in my checking account isn't my total amount. And my wife and I really try to hit that 50 to 60% of our income we try to save. And so the money comes in, 50% of it's already gone in a savings account. Now I have to manage those accounts, I have to buy stocks, I have to invest, all that kind of stuff. But the nice thing about it is it's not in our checking account and we don't have to worry about it. And we live within the means of our checking account. So you get to the end of the week and you don't have money to buy gas, guess what? We don't drive all the places that we would. We don't go up to Tahoe for the weekend. Or if we don't have extra money for food, well, we're living off leftovers for the next couple of days. You just make do. Just like every other family in America, you just make do on what you have. You already took out your money for savings first. And that is a great strategy for making sure that you have it on a side in a separate account. Now, the thing I like to do is for the first 5 to 10 years of my career, every time I got a raise, I would just divert that money into my 401k until my 401k was maxed. And once my 401k was maxed, I was diverting the money into my Roth IRA. Once that was maxed, I was diverting it into my health savings account. Once that was maxed, you get to a point where you've put money into all these different places and you are hitting these huge savings numbers, but you just did it slowly over time and you don't feel the pain because you got a 4% raise. Okay, it went there. Didn't notice it, right? I still live the same lifestyle that I was living before I got the 4% raise. Now, does that mean that I buy all the toys that I want all the time? No. It means that I'm a little bit more frugal. I don't have an Xbox and a PlayStation and all these other toys. My house, we have one TV. I have, one main computer for me, one main computer for my wife. That's it. We don't have a bunch of iPads. And so it's really just living within your means and setting what your means to you, and making sure that you have that money set aside for investments. Now, I wouldn't necessarily recommend putting everything into your 401k or Roth IRA or all those other tax special accounts because those are retirement accounts. And if you want a money market account, so that you can invest in stocks independently, or if you want to go and buy a house, like something that you can rent out and start making rental income out of, I definitely recommend considering those things as other financial options. But those are great strategies. The other thing is is, especially in investments, you have time. This is another great investment strategy. You have time to earn money. And if you pay attention, invest at the right time can make the whole difference between being successful and not being successful, especially in my opinion, in real estate markets. Right now, the real estate's super high. My wife and I have talked about, maybe getting a loan to buy a house or a duplex or a triplex so that we can rent out to maybe some of the local college kids, which is a great idea, but the market's too high for me. The market is too high for me. And so even though I suggest getting in now, what I'm doing is I'm putting that money aside so that we can buy a duplex, right? I'm investing it in markets like stock markets temporarily so that I can earn some kind of an income off of it. It's not doing nothing. But when I'm ready, I can take all that money and invest it inside of that house or that duplex, triplex, so that I can actually make another set of real estate investments. And so you have time. So watch the market, find good opportunities. If you find a good opportunity like a short sale, absolutely go for it. Don't bypass great opportunities. That's not what I'm saying. I'm just saying you have a long period of time. Sometimes you can do things like put your money into bonds so they have that guaranteed level of income over a short period of time. And then when you have an opportunity, then you can cash it out and actually invest in something bigger. And that's the last strategy. So the last strategy is something small now turns into something larger, bigger, or larger later. So don't worry about the fact that you're only investing small amounts of stuff now, right? You can always make more investments later. But when you have money, especially when you put it aside, investing constantly small amounts over time eventually means that you have a lot of money saved. So don't discount small investments now. Don't think that you have too little to invest. You never have too little to invest, right? I mean, I remember when I was a lot younger and in college, when I had extra $50, I'd just go and invest it. So instead of going out and buying that loud brand new stereo for my crappy car, I just took those $50 and I invested it, and that's worth a lot more than $50 now. Okay, so that is my basic investing 101. Let's go over that again. Understanding that if you want to be poor, just spend everything. If you want to be middle class, only have liabilities like a mortgage or a car. If you want to be wealthy, you got to start building assets. And assets are anything from stocks, bonds, precious metals, real estate. There's a lot of different types of assets, but the most powerful assets are passive income sources, things that constantly give you more money back, right? And so you really want to invest as much as you can in those passive income sources. Next thing is make sure that you're investing as much as you can and as frequently as you can, and that a small amount becomes a large amount over a long period of time. So don't be afraid of small investments. And last but not least, follow your plan. Create a plan and follow the plan. And anybody can become wealthy. Anybody. Personally, I avoid get-rich-quick schemes. There's no such thing. It's hard work, determination, smart investing. That's how you become wealthy. Okay. Next segment is we're going to get into a little bit better of understanding taxes and how your taxes work. Okay. So first off, we talked about a savings plan earlier, right? I also want to talk about a tax plan. So I'd never even heard the term tax plan before until I was talking to a big wig business executive, and he was telling me, so what does your tax plan look like? What is a tax plan? Well, a tax plan helps you minimize how many taxes you're paying, number one, which gives you more cash that you can then go invest in other things. It's also, after you put your money into tax shelters, how are you going to pull it out so that you can pay less taxes overall in the long run? Now, this is something that most people don't even talk about. It's not something that's widely advertised that you have tax plans, but any wealthy person or business has a tax plan, and they're not evading taxes. That's a really bad nomenclature. What they're doing is they're learning the tax code and understanding what's in place to allow you to be successful, okay? Because believe it or not, the federal government, they have very little, they have like 5 pages of their tax law for the taxes you have to pay, and they have 1,000 pages for what you can do to save money. So whether you realize it or not, the tax code is actually in your favor. if you understand taxes, you can save a lot of money and still be doing your fair share, right? So there's a couple things I want to talk about first. First one is tax bracket. Tax bracket is important. Now, if you're single and you don't have kids, you're kind of stuck in the single bracket, and there's a range for how much money that you pay. Now, America has what's called a tiered tax system, and what that means is you pay the lower tax rates for that specific amount of money. So let's say that I'm a single and the current 10% tax rate is from 0 to 10,000 or 9,875. But let's use even numbers because it's just easier. So 0 to 10,000 is 10%. So you pay 10% on that $10,000. Now, if you make more than $10,000, you fit into the next tax bracket. So the next tax bracket up is 12%, and that goes as a single person all the way up to $40,000. Okay. But what that means is the first 10,000 is always taxed at 10%. The whole thing isn't taxed at 12. The first 10,000 is taxed at 10. The next 30,000 is taxed at 12%. So as you learn to make more money, the money that gets taxed at the higher and higher rates is only the money that's over that next bracket. So if you make $500,000 a year and you sit in the 35% tax bracket, only the money over $500,000 gets taxed at that 35%, right? So from, I misspoke. Anything over 200,000 is taxed at that 35%. So 200,000 to 500,000, that's taxed at 35%. But if you had money from 150,000 to 200,000, well, that's taxed at 32, and the money between 80,000 and 160,000 gets taxed at 24. And so your total tax rate is not the maximum number, right? Your total tax rate is an aggregate of all the taxes you paid at lower levels, and the lower level money you make gets taxed less. Now, this is a big problem for married people, especially married people with dual incomes, because unfortunately, the way tax brackets work is your dual income all gets stacked up together, which means, just for simple numbers again, let's say that you make 60,000 and your spouse makes 60,000, okay? Well, that means you get all, let's just say that you're the first person on the tax. She could be first, it's irrelevant which order. But whoever's first, they get taxed at all the lower brackets, and then you get stacked on top of them. So you don't get taxed like you make 60,000. You get taxed like you make 120,000, and all of the second person's salary gets taxed at the maximum rates, which in that particular case, if you were married filing jointly, you would be almost the majority of your money would be taxed in the 22% bracket. So you are, as a married couple with joint income, one person is paying far more taxes than the other person, but you're a family, and so the government charges you differently. Now, the nice thing about that is the tax brackets shift based on whether you're head of household or not. And so a married couple filed jointly is considered head of household, or a single person with a dependent, i.e. a kid, or an old person that they're taking care of counts as a dependent. Therefore, they're also head of household. So the head of household difference is pretty big. So, I guess I misspoke. So married filed jointly has a different tax bracket that's even better than head of household. There's some minutia there. We'll get into it in a little bit later, but the main thing to realize is if you're single, you're paying 10% on the first $10,000 you earn. If you are married, you're paying 10% on the first $20,000 you earn, which is actually pretty good. So it's double the money at the same rate. And then the brackets move up from there, but it saves you a lot of money to file jointly typically. Now, if you're married and filing separately, it's essentially like the two of you are filing as single. It's bad. In fact, I have never met a case where two married people filing single or filed separately made more money. So that's bad juju. You can, if you're using something like TurboTax or H&R Block software, they'll let you kind of just click a button and switch between the two. But I almost always guarantee that married filed separate or married filed jointly is better than filed separately. And head of household is $0 to $14,000, right? So if you have one person that is living by themselves with dependents, they only get taxed 10% on the first $14,000. So that bracket shifting up saves you a lot of money. So a good example of where it matters. So if you're single with no kids, doesn't really matter. If you're married and you're filing, you should probably file jointly, doesn't really matter. Where head of household really matters is my wife and I, when we first got together, we were separate. We weren't married yet. And she had 2 kids from a previous marriage, and we had 1 together, which is my youngest. And so we were both separate. Now, she could have claimed all 3 kids, and I would have been filed single, and she would have been filed head of household. But what really saves you a lot of money is I claimed our child, and she claimed hers too, which means the 2 of us are now filing head of household. And because both of us are filing head of household, we both only get taxed 10% up to the first $14,000, and all the rest of the tax brackets shift with it, which means by filing separately or filing as both head of household, by me claiming 1 kid and her claiming 2, I think it saved us $7,000 or $8,000 in taxes. So if you're in a situation where you and a partner are not married yet and you have multiple kids, you get a $2,000 tax credit no matter who claims the kid. So if he claims a kid or she claims a kid, as long as both of you claim 1, you can both claim head of household. And if you can both claim head of household, it saves you a substantial amount of money on your taxes. So in that particular case, just be aware you should not have 1 file single and the other 1 file head of household. You should both find ways to both claim head of household. It'll save you a lot of money, okay? Just kind of an example. I like this example. I'll put it up on the screen. But let's say that the progressive tax rate, just a clarification. Let's say that you made $50,000, okay? The first $9,700 would be taxed at 10%. The next all the way up to $40,000 would be taxed at 12%. And then only the last $10,000 would be charged at, or would be taxed at 22%. So those are the tax brackets: 10, 12, 20, 22, 24, 32, 35, and rich people that don't count as us make crazy amounts of money. But the most important part is most of your money at that point, if you made $50,000, most of your money is actually being taxed 12% and 10%. So you're a little bit, you probably average out to somewhere about 11% tax rate, right? And only a small portion of your money would be taxed at the 22%. So aggregate, you're probably looking at a total of maybe a 15% tax rate. So even though you make money into that 22% category, you're not paying all of your taxes at 22%. It all averages out to somewhere that's slightly above 12, because that's where most of your money was actually being taxed at. Okay? Now, I want to get into some savings plans, savings programs, understanding the difference between like a Roth IRA versus a 401k. These are super important to understand that they are tax shelters, okay? Now, the 401k is important because what it does is you put money in there before you tax it. And the maximum number of that for anybody right now is about $19,000. So you can put up to $19,000 that doesn't get taxed. So if you're trying to save a good chunk of money, and let's say that you make $50,000, you can save $20,000 if you're meeting the 50 to 60% of what you should be trying to save, and you put $19,000 into your 401k, you have no money that will be taxed at that 22% tax bracket, right? No money. In fact, you save potentially at 20, so you have 10,000 at 20%, right? So 10% is 1,000, so that's $2,000 you would lose to taxes. So you would save $2,000 doing your taxes by putting all that money into a 401k, right? And so that's huge. Save thousands of dollars. And if you save $2,000, guess what? You can take that $2,000 and invest it somewhere else. Just saying, right? If you're not going to pay taxes on it, might as well invest it to make more money later. Now, the thing is it grows tax-free. So it's tax-free to put it in, and it grows tax-free. So that's a stock account, typically. There are some subtle things you can pull money out of that account to make certain investments, like in real estate, but you got to really be careful on the laws around that stuff. But what you can do is you just let it grow. So you invest it in some basic mutual funds. Mutual fund is just groups of stocks. I prefer mutual funds that follow the general market. I find that most managed funds don't make as much money as the standard market. I'd rather just invest in the S&P 500 or the NASDAQ, just put my money in and let the market go, do its magic. But it's tax-free. Now, when you pay taxes on it is later on in life, when you pull money out when you're retired, you only pay taxes on what you pull out. So let's say that my house is paid off, my cars are paid off, I'm retired, I'm 65 years old, and I pull $20,000 out to pay for my cost of living for the year. Well, the nice thing is I'm only paying taxes on that $20,000 that I pulled out. And based on what we're currently looking at, that $20,000 would be at mostly, or half of it would be at 10% and half of it would be at 12%. So you got like 10 point or 11% average tax rate, right? So it saves you money when you retire to put it away because your income should be less and you're only pulling money from it when you need it. Now, there's also a Roth IRA. A Roth IRA grows tax-free, but you have to pay taxes on it now. Okay, so there's pros and cons to that. If you are not making a lot of money, it's better to put, or if you are single and you don't have a house and you don't have kids or dependents and your tax rate is very high, putting money into a 401 or a Roth IRA may not be a good idea because you're going to get taxed on that rate that you make money now, right? And so because you're getting taxed on it now, if you're sitting in a tax bracket that's 25, 35%, you're paying 35% taxes. Now, if you're in my case, which is I have a house and I have 3 kids, right? Those are tax credits. So I get a tax credit for my 3 kids. So each one of my kids gives me $2,000. And because I have a tax credit, that lowers my total percentage in taxes. So if my taxes are somewhere in the 15% range, it's better that I'm paying 15% taxes than 30% taxes. So I want to put money into my Roth IRA while I'm only sitting at 15% tax. Because later on in life, if I'm making a lot more money, I don't want to pay taxes on that money. And it grows tax-free and you can pull it out tax-free. So a Roth IRA is great for big expenditures later on in life. So you pay taxes on it. So if I'm married with kids in a house, I pay low taxes now. Later on in life, I may want to buy something like a new car or a new house or something. I can pull that money tax-free from a Roth IRA. So big expenditures later in life, Roth IRAs make perfect sense to invest in if when you put money in, you're not making a lot or your taxes are really low. If I'm single now and I have no kids and I'm making a ton of money, because let's say that I'm a business guy and I just get really lucky, it may not make sense at all to put money in a Roth IRA, because if you're getting taxed at 20, 30%, you'd probably be making better off to just put that money in a standard stock account than to necessarily put into a Roth IRA. So it depends. It depends on what your current tax bracket is, where you're currently sitting. And so you want to be really careful as to when you're putting money into those different accounts. The other thing that's really negative about those accounts, by the way, is you can't pull money out until you retire, except at huge tax penalties. So if you want to pay an extra 10, 20% on taxes to pull it out early, you can. But the way I play those accounts is the second money goes in, it's gone. I will never see that money again until I retire. My wife and I max both of them. So we max our 401 and we max our IRA every year. And that sucks because we're taking most of the money that we make and we're putting it into those funds. But when we retire, we'll have a lot of money to live really, really well. So it's good to do it. So there's other things that you can do for tax shelters. And again, just like the 401, it brings your total taxable income down, which means you're paying less taxes because that money is considered tax-free. First of all, there's something called a health savings account. If you have a healthy family, getting a high deductible healthcare program is probably the smartest thing you can do. If you spend a couple $100 a year on medical, you shouldn't be spending a lot of money on a high cost plan or with a low deductible because it's useless to you. So, I mean, we had one event a couple years ago where my son got kicked in the head with a soccer ball. He had a concussion, so we had to get an MRI that cost us like $1,000. But typically we don't spend more than $500 on medical every single year. And so if you have a high deductible plan, that government gives you permission to have something called a health savings account. Now, don't confuse this with a flexible spending account. A flexible spending account, you put in like $500 in a year, January hits, you lose your money. Your money's gone. But with a health savings account, it's your money. It's your account, which means if I put in $500 this year, it's my money next year, which means I don't have to put in as much money next year. Now, the max per family right now, I think, is $7,000. So if you have a family, you put $7,000 in. So if you get a high deductible plan through your employer and you put $7,000 into your HSA, it may actually cost you less money over the course of the year to put $7,000 into the savings account. And there's a couple big benefits to the savings account. So first off, it's your money, which means you put $7,000 in a couple years in a row, you have tens of thousands of dollars in there that any medical problems you have in the future, you can use that on medical tax-free, okay? So you don't get taxed on it. It lowers your total tax amount. It can be used for medical, which includes dental work. So if you have dental work, you can pay for that with your HSA. If you have a chiropractor, you can pay that with your HSA. So there's a lot of uses for what that HSA can be used for. And the other important thing is a lot of HSA plans allow you to invest that money, which means you can take that money and you can invest it in stocks and bonds, and it can earn value over time, which means let's say you put in $10,000 now, 20 years from now, it could be worth a lot more, right? So you can treat it like an investment account for health savings money. And as we get older, medical costs go up. So it's always a win-win. You pay less taxes, save money for a rainy day, you can use it on all your medical expenses, and you can invest it so that it grows over time as a passive income source. Dude, HSAs are amazing. I recommend that if you have the chance of getting one, you should get one, okay? Last but not least, if you have kids, there's something called a dependent care account. I believe it's like $5,000 a year. So $5,000 a year, it's tax-free. So again, it pulls money off of your how much money you're paying taxes on. And if if your mom comes over and you're paying her every single week, like let's say you pay your mom $100 a week, that's $400 a month, that's $4,800 a year, that's almost the $5,000, and you can get a tax break on your tax return for that money that you're paying your mom to watch your kid, okay? That means she gets money and you save money on taxes. Totally worth it. And so my recommendation for these types of things, depending on your tax situation, there are some caveats, but you should be putting as much money into your 401k as possible to lower your tax bracket. You should be putting as much money into your health savings account to lower your tax bracket. You should be putting as much money as you can into a dependent care account if you have kids to lower your tax bracket. Now, at some point, your kids watch themselves. They get, 12, 15 years old, and dependent care accounts aren't as valuable, but while you can, you should. So if you think about that, if you let's say you and your wife, go back to the $60,000 example. If you and your wife make $60,000, you get taxed on $120,000. If you're putting $40,000, $19,500 each for your 401, so $40,000, 20 and 20, and you're putting $7,000 into your HSA and you're putting $5,000 in your dependent care account, then that's $52,000 you don't get taxed on. And it's still your money. It's just your money for a rainy day. It's just your money for when you retire. You get zero taxes on that money, and it's totally worth it to invest that as much as you can. And again, you don't do it all in 1 year. Every single year you get a raise, just tweak up the savings to your 401 a little bit higher until you hit the max every year. Okay. And I think that's it. That's all I got. I think it's really important to understand that you can save $50,000 in taxes. And if you go back to the $50,000 example, let's say that you're married filing jointly, $50,000 is at 12%. And so, you're talking about $1,200 per $10,000. So you're looking at $5,000-6,000 that you're saving in taxes just because you put money into savings accounts that are tax-free. Okay, so just be aware that there are those options. Roth IRA won't save you on taxes now. Roth IRA is for big expenses later, but it's a good opportunity for tax plan. Now, again, tax plan means that you look at how you're putting money into savings and where you're putting it so that it can affect your tax brackets, because you want to bring your taxable income as low as possible, right? The other part of your tax plan is to how do you pull money later on in life out of these accounts without spending a lot of, or without paying a lot of taxes. And so a good example of that is, 1 year you may want to buy a house, so you pull money out of your Roth IRA. You're not going to pay any taxes to buy the house. You still pull a little bit out of your 401k, and then the next year you decide just to hold off on all expenditures because you only want to pay a low amount of taxes for your 401k that year. Another thing is a lot of people, when they first retire, you can take a certain amount of your 401k money and transfer it into your Roth IRA at whatever your current tax rate is. And if you retire and you own your house and you own your cars, you have an opportunity to, at the lowest possible tax rate, moving a lot of your money from your 401k into your Roth IRA and get a lot of the same benefits as if you were in a lower tax bracket for that year. So these are the things about tax plans. You should know your tax code. There's a couple good books online for learning about taxes. Definitely highly recommend doing some research on your own to figure it out. But you should have both a savings plan and a tax plan. Your savings plan, just to kind of reiterate, should have passive income as a primary goal to get as much passive income as you can. And then your tax plan should be minimizing how many taxes you have to pay to the federal government every single year. And again, none of this is illegal. This is all legal, and the government wants you to save money. The government wants to give you an opportunity to save as much as you can. Okay, that's all I got. Hope you learned a lot. Hope it makes some sense. I'll put some links down below so that you can go look up what the latest tax brackets are. There's a couple good tax calculators online. I'll toss that your way. And I'll also try to put in the comments below some links to some good sites that kind of explain Roth IRA and 401ks, just if you guys are interested in more how it works. Enjoy the rest of your day. Have a good one. This is James McDuffie. Bye.